So let's get started.
Like me, don't.
All right. So let's get started. So today, you guys will be learning about diversifying portfolios and basically fundamental analysis. So I'm going to pretty much walk you through diversification and some strategies I use as a beginner investor for those who are interested in the long-term factor. So it is a management strategy that blends different investments in a single portfolio. The idea behind diversification is that a variety of investments will yield a higher return. It also suggests that investors will face lower risk by investing in different vehicles. So basically in this little graph right here, is just showing that they don't have a lot of cash. Most of their money is into things. It's diversifying your portfolio. So honestly, this looks kind of like my portfolio in real life, except with all this healthcare and stuff like that. But I do have lots of money in dividends. I have mostly so yeah, it looks like mostly on this side. I usually just invest in dividends and I have a large portion of cash. I sit on a lot of dividends and a lot of cash to day trade with. So I have day trading money, dividend money, and swing money, if that makes sense. So I have my money in different areas and real estate, all of that other stuff. So key takeaways: investors are warned to never put all of their eggs investments in one basket, which is the central thesis of which the concept of diversification lies. To achieve a diversified portfolio, look for asset classes that have low or negative correlations so that if one moves down, the other tends to counteract it. ETF and mutual funds are the easiest way to select asset classes that will diversify your portfolio, but one must be aware of hidden costs and trading commission. So first thing you guys need to know is, what is an ETF? You will see this term a lot. It is an exchange traded fund. So basically it is a fund comprised of lots of companies. It's pretty much like a large investment portfolio. A stock ETF or exchange traded fund is an asset that tracks a particular set of equities similar to an index. It trades just as normal as stocks would on an exchange, but unlike a mutual fund, prices adjust throughout the day rather than at market close. So SPY and QQQ will be your two main ETFs you will be looking at. QQQ is for the tech stocks, SPY is for the overall market, the S&P 500. So what is the SPY ETF? So basically, the SPY ETF is one of the most popular funds that aim to track the Standard & Poor's 500. So basically, when you hear the term S&P 500, this is comprised of 500 large and mid-cap U.S. stocks. These stocks are selected by a committee based on market size, liquidity, and industry. The S&P 500 serves as one of the main benchmarks of the U.S. markets and indicates the financial health and stability. The SPY is very diverse. It has 21%. So you will always see this. IT runs the world right now. Remember they said computers would take over 20 years ago when we were young? They're correct. Information technology, number one investment, second healthcare, because of course it's big business to make up diseases and charge for the vaccine. And then financial services, banks, of course, the scam where you put your money in the bank and they invest it into other things, and then they give you a penny for every $1,000 you give them, you know? So, I mean, except for information technology, these two are scams. But 10% communication service, industrials, consumer defense, and all of that. That is what it's comprised of. Y'all like that little comedy, little woke comedy? So what is the QQQ ETF? Invest code QQQ is basically information technology, to make a long story short. It is, so basically stocks like Amazon, Facebook, Google, Apple, of course, if those are doing bad, they'll do bad because 50% of their portfolio is in Apple and Google and Facebook and all of that. It's in information technology. So if you look here, you will see that SPY and QQQ have similar holdings. The number one holding is Microsoft. Number two is Apple. Number three, Amazon, Facebook. And then they're a little bit more diversified at the end. They decide to hold some Johnson & Johnson as their fifth, but mostly it's the same. So we look here, SPY and QQQ are ETFs that control the general outlook of the market. So basically, if these guys are down, well, let me get that off. If these guys are down, both of them, the market is down. The market follows these two. So always remember this. Check if you want to see the overall scope of the market, first thing you need to do is look at these two in the morning. First, these are the first stocks you need to look at in the morning. Are they up or are they down? Futures, stuff like that. So you would use SPY as your future outlook if you're a day trader with large cap stocks like most of us, right? And QQQ for tech stocks. So if you go to finviz.com and if you wanted to create a portfolio, if you go to finviz.com on their site, you will see a chart like this. You'll be able to see every day what companies are doing, basically. So that's one tool you can use. So here is my Robinhood portfolio about 4 years ago, right? So 4 years ago, this is my Robinhood portfolio, 3 or 4, one of those. And I used to primarily hold shares back in the day. And then I switched to options because I just knew how to grow accounts. Doing shares, I started on, what was it? It was Robinhood, but it was another app I started on where I put in a lot of money into it. And then I made money on that. Then I branched over to Robinhood. And that's how I started out. So if you can see, I have a very diversified portfolio. So it would be days where marijuana would be down, but stocks like where was it, Apple and Square, all of these would kind of save me, basically. So, but I was kind of 50% in marijuana and the other 50% in shares. So for some reason, it would kind of counteract. If one was down, the other one was up, if that makes sense. So if weed was down, tech stocks and would be up, and then vice versa. So I would only climb, basically. And then I did that until I reached to about 20,000. So I started way before this, but I started with about 5,000. I invested into Canadian marijuana at first, grew to like some money. I would make like $1,000 a month off that because they were booming, they were in the uptrend. And then I started buying tech stocks to diversify because I hated the down days, and then it just rose and rose and rose until about 20,000. And that's what kind of kickstarted my option trading career because I made so much money investing, just holding shares. So what is extrinsic value? Extrinsic value is a measure of an asset and its worth. The measure is arrived by means of an objective calculation or complex financial model rather than using the currently traded market price of an asset. In financial analysis, this term is used in conjunction with the work of identifying as nearly as possible the underlying value of the company. So basically, extrinsic value is you do it all the time. If you're trying to buy a car or a house, right, and you believe this house is worth 250,000, but on Zillow it says 400K, you probably want to wait till the house drops to 250,000. You're like, okay, I'll just wait for the housing market to drop. These guys are tripping. That's you giving the house an extrinsic value. So basically, in the stock market, it's the same. you're looking at a company and you're looking at their data, their their debt to income ratio, stuff like that. Stuff Mike will teach you in the next 30 minutes. But basically, you will look at a company and you will give them a price range, and you will say, I believe this company is worth this. And that's how you will invest. So there are people who literally wait months, years for a stock to drop to a certain price and will buy in. Oops. So why calculate extrinsic value? Analysts and investors calculate extrinsic value for an important reason. They identify under and overpriced stocks. If an investor calculates an extrinsic value of 300 for a stock, it is trading on the market for 250. It will be perceived as a bargain price and a good investment. So how to calculate extrinsic value, you can screenshot this, but extrinsic value, I'll give you guys like an app to use. So you don't really have to, I'll give you a cheat code of an extrinsic value app that I find useful. You can screenshot this if you want to, but the dividend discount method and the discounted cash flow method are two ways people find them, and it is a formula to them. So you guys, if you are interested in portfolios, which most of you will probably not do this, I'm not going to lie. So most of you will not, it's intrinsic value. So it says it right here, intrinsic value. Whoever said extrinsic value, it's intrinsic value. Anyways, a great fundamental analysis app is Simply Wall Street. And with Simply Wall Street, they basically give you extrinsic values and tell you if a company is undervalued. And of course, extrinsic value is subjective, but I believe from based on what I've seen and studying the app for about 2 years, they've been kind of spot on valuations of companies and fair pricing. So basically, what they believe, so let's just say right now Google is at 1,400, right? But they believe it's fair pricing is at 1,500. That says you got a good $100 to get in and buy it. They're saying Google, this was Simply Wall Street, and the other one was finviz.com. So this one is a 1403, and they believe it's fair price at that. So you would buy in. They would say, okay, you can still buy. But in my opinion, it's best to buy when it's very undervalued. And you can go look at, here in Simply Wall Street and take a look at it. And they give you all of this. They let you know they have a lot of assets and not a lot of liabilities. So short term, they're doing pretty good. So remember, assets over liabilities. If you don't learn anything in life, you need more assets than you have liabilities, right? So if your assets outweigh your liabilities, for instance, if you have more student loans plus car loans plus housing loans plus all of these loans and all this debt, you have a lot of liabilities, and then your assets are probably down here. That's how a person is. So in your eyes, that's a bad company. They have lots of they have lots of liabilities and no assets, right? But these companies are the opposite. They have lots of assets and no liabilities, right? So that is very good. They're in good standing. But some companies aren't like that. You know what I'm saying? Like some companies have lots of liabilities. So it's hard for them to be profitable. And you got to look at that, whether companies are profitable or not. And then here are the apps I recommend downloading. So I only pay attention to a few of these. This one, this one, this one, this one, and this one, right? So I only pay attention to these five. So you can screenshot. I do look at all five of these each day. And these are a screenshot from my cell phone. So As soon as I wake up, while I'm brushing my teeth, the first app I go to is I actually look at this app before I brush my teeth. This one, and while I'm doing it, go look at some news, and sometimes I look at this one. I go look at this one, and then this one will kind of give me tweets. So this one will update to my phone, but I look at these two every morning, and then Yahoo Finance, I go and read up like during the nighttime and go see what's up with them. Oops. So yeah, that is it. So I hope you guys enjoyed this short basic fundamental class, and it will get a little bit more advanced when Mike get on. So get your thinking caps on and prepare for learning. I'm gonna pass it off to Mike.
What's up, guys? Welcome to week 2, day 2. Before I get started today, I just want to make sure everyone can hear me and everyone can see my screen. All right, perfect. So I am going to be talking about fundamental analysis and everything you have to do a financial breakdown. If you're going to be a day trader, it's not really required for you to know any of this, but it's definitely good to have this as a base, for knowledge, a base for the financial background. If you guys ever want to take your place in the financial industry to that next level, you want to be a financial planner, you want to work in investment banking, whatever it may be, then this is something that you'll definitely have to learn. Or if you want to trade long-term stocks to kind of get their true valuations, where they should be priced, and if they're just, if they're junk companies and they're just overvalued, then that's also something that you can get out of this. So I'm going to be talking about fundamental analysis today. Let's get started. So what is fundamental analysis? It's the stock market analysis of breaking down a company's financial information to find intrinsic value versus market value. It requires an in-depth study on a company's past performance, present performance, and future expectations. Yahoo Finance provides a great free rundown on almost every company's financials and balance sheet. So these are some common terminology that you'll see when talking about fundamental analysis and within the finance industry. I'm not going to read over every single definition, so I recommend taking a screenshot, but I would go ahead and give you guys the equations for each one of these. So debt ratio is liabilities divided by assets. If you don't know what a liability versus an asset is, I'm sure most of you guys have a liability and have an asset. So an asset is a house, right? So if you buy a house, then that, the money that you put towards that house is an asset. A liability, taxes are a liability. There's a lot of different kinds of liability, but basically if you have something and it's depreciating in value, or you're paying towards something, then that's a liability. And then an asset is something that you buy and then you could sell that back. Debt to equity ratio is liabilities divided by equity. Interest cover ratio is EBIT divided by interest expenses. And EBIT is earnings before interest and taxes. So it's earnings before interest and taxes divided by interest expenses. Current ratio is current assets divided by current liabilities. Quick ratio is current assets minus inventory divided by liabilities. Cash ratio is cash and cash equivalents divided by current liabilities. Profit margin, very simple, is profit after tax divided by revenue. ROE, or return on equity, is net income after tax divided by shareholders' equity. Gross margin, so gross profit margin equals gross profit divided by revenue. EBIT, like I said earlier, is earnings before interest and taxes, and that is profit times loss plus finance costs plus income tax expenses. EBITDA is earnings before interest, taxes, depreciation, and amortization. And the equation for that is revenue revenue minus expenses, excluding tax, interest, depreciation, and amortization. So these are all, very common terms that you will have to associate yourself with if you go into the finance industry, if you want to become a financial planner, whatever it may be. Even if you're majoring in finance in college, you'll hear all of these terms on a test or whatever it may be. It's something that you have to become familiar with if you're going to own a business, and take that next step into the finance world. Now, talking about actually how to do a fundamental analysis, these are your key metrics, right? So you have your earnings per share, which is EPS, price to earnings ratio. You're going to hear these top two the most. So earnings per share, EPS, and price to earnings ratio, which is P over E. Price to book ratio is P over B. And then return on equity, with, like I said, is ROE. You'll hear most common. And then beta. So these are your key metrics of a fundamental analysis. And I'll show you guys exactly what each one of these mean. So earnings per share, or EPS, is essentially profit equivalent to shares. So EPS shows how profitable or non-profitable a company is. The higher the EPS, the better the company is valued. So a high average EPS means it's a strong company. An unusually high EPS potentially means they had a good quarter, but earnings could decline, so be cautious, right? So you're going to be looking at, when you start looking at fundamental analysis and trying to determine valuations of a stock, valuations of a company, you'll be calculating an EPS, right? Which is net income minus preferred dividends divided by end of period common shares outstanding. So if you see one unusually high EPS, that means the company could have had a good quarter, but it could decline. It's not a guarantee. And then an unusually high average EPS means the stock price should increase, so stock price and EPS align. And then the next big common thing is price to earnings ratio. You hear this a lot, P over E. So P over E is share price divided by EPS, where P over E equals price to earnings ratio. Share price is market value per share, and then EPS is earnings per share. So P over E is company payouts compared to stock price. It's calculated by dividing per share by earnings per share. So example, Tesla price per share, this is hypothetical. Let's say Tesla price per share is $800 and the stock pays $2 earnings per share. That would be 800 divided by 2, and you would get 400 would be your PE. So the lower the PE ratio, the higher the earnings compared to stock price. The lower PE, typically better value stock. Unusually low PE could have significant long-term potential. Standard PE ratios range between 10 and 25. So most of the time, when you calculate a PE ratio, it's going to be between 10 and 25. That's the standard. However, let's say in a time like coronavirus, in March and April, when the stocks all crashed, right? A lot of those stocks had very low PE ratios just because their actual market value per share was so low. So their share price was so low and their earnings were higher, right? So they had a lower PE, and that means that they could have significant long-term potential. So that's why, typically long-term investors, financial planners will advise you to actually buy on those dips, like in March, because if you're thinking long-term, these, 99% of these blue chip companies will survive. So PE ratios below 10 typically means undervalued. I don't know if any of you guys were in the chat when I called AAWW. It was at $18 a share when I first mentioned it, and it had a PE ratio of about 5. So it was undervalued. Its earnings were crazy because with upcoming demand in March, with all of the coronavirus, they had to ship internationally. So they had a PE ratio of about 5. It dropped off because of the coronavirus in March. And so I picked it up, and I said long at 18. And now I think it's worth like $60 a share, something like that. So, I quadrupled the return on investment on AAWW. And that was solely based on that fact that it was undervalued at the time. So if you're looking at these PE ratios on a very solid company that doesn't have a chance of going out of business, then you want to look for the ones that are falling on that 10, anywhere from 1 to 10, right? PE ratios over 25 typically means the company's overvalued or it has large future expectations. So, Amazon has a PE over 25, but that's because they have large future expectations. I mean, everyone in the entire world thinks Amazon will just keep going up. I mean, why not, right? They make a stupid amount of money. So it's very common to see high PE ratios on solid companies that have a lot of future expectations. Price to book ratio, or P over B, it calculates the stock worth versus book value of company. So example, let's say Roku is worth $400 million and has 100 million shares outstanding. So the book value per share is $400 million, which is the worth, divided by the 100 million shares outstanding, and you get a $4 book value per share. Now, if Roku is currently trading at $100 a share, which it's not, but it's hypothetical, if Roku is trading at $100 a share, the PB value is that book value per share. So you take the 100, which the stock is currently trading at, the price it's currently trading at, $100 a share. You divide that by the book value per share, and you got the book value per share by dividing the worth of the company divided by the shares outstanding. So you take the 100 divided by the 4, and you get 25, and that would be your price to book ratio. PB ratio is share price divided by book value per share. Book value per share is company worth divided by shares outstanding. If the PB ratio, so that 25, is more than 1, investors believe stock growth at fast pace. So you'll see this is very common in stocks like Roku, whatever, Beyond Meat, probably, whatever company has a lot of potential growth at a fast pace, then you're going to see a price to book ratio higher than 1. So you can calculate this, like I said, just divide the worth of the company by the shares outstanding, and then take that number and divide that by the current share price. And there you go. There's your PB value, your price to book ratio. So it's not uncommon to see high price to book ratios on stocks that have a lot of potential growth. Return on equity, I would say more commonly known as ROE, is net income of a company divided by shareholders' equity. So example, let's say stock X made $100 million last year in net income, and the shareholders' equity is $500 million. That means the ROE is 500 million, which is the shareholders' equity, divided by 100 million, which is that net income from last year. So it's 500 million shareholders' equity divided by 100 million, the net income, and you get 5%. You divide that, and then you make it a percent. So shareholder equity divided by net income equals ROE, and it's always expressed in a percent. The higher the ROE, the better. So you want to make sure that a company has a high ROE, which is a return on equity. And the last part of this fundamental analysis is figuring out your beta. So beta is price correlation to industry, and it compares the price of the stock to its industry peers. Betas are calculated by comparing stock to its primary index. Beta typically varies between -1 and 1. Beta over 0 equals stock correlates to benchmark. So if the beta has over a 0, then that means the stock is correlating to its benchmark. The higher beta, the higher the correlation. So if it's at 1, then it's going to have a high correlation to its benchmark. And then also if it has a higher beta, it means it has higher volatility. So I don't know how many of you guys are actually in the chat, but you'll see very common, we'll say we trade high beta names. That means, we like to see those higher, in that higher range. So around 1 on the betas because they have higher volatility. So like NVIDIA is a stock that has a high beta because it has a lot of range throughout the day. And that's what you want. As a day trader, you want to make sure that there's a lot of range, a lot of volume, and a lot of liquidity in the stock. So higher beta indicates higher volatility. Beta below 0 means the stock is inverse to its benchmark and it does not correlate. Beta below 0 also means stock likely to remain unvolatile. That's not what you want. If you're a day trader, you don't want to trade low beta stocks. You're just not going to make as much money. They won't have good option contracts. So if you're trading, you're trading intraday, you're day trading, you want to make sure that you are trading high beta stocks because they have the highest volatility, the highest ranges, and the best volume intraday. So let's do a company breakdown using only those 5 key metrics I just went over. So Apple, looking at Apple, everyone should know Apple. I mean, it's an incredible company. So current earnings per share. Now this was before the split. I did this breakdown before the split, but it doesn't matter. I mean, it's the basic concept, right? So the current earnings per share is 12.73. Shows that Apple is strong and has growth potential on year-to-year basis. Current price to earnings ratio is 24.47. Not bad at all. Remember, I said it goes from the normal range is between 10 and 25. It is on the upper end of that. But remember, like I said, it's normal for a company that has a lot of potential growth or a lot of future growth expectations to be on that upper end or even past that upper end. All right, so 24.47, not bad at all. Pretty average, but shows room for growth potential. Current price to book ratio, 15.3. So remember, I said if you have a price to book ratio that's higher than 1, then that means that the company is growing at a fast pace, or investors believe it will grow at a fast pace. And then current return on equity, 46.25%. So that's very high. I remember the hypothetical scenario I gave you guys, now is only 5%. So the current return on equity is 46.25%. That's very, very high. It shows a very healthy, strong company. And the beta is 1.17. So like I said, if you have a beta closer to 1, even just a little bit above, that means the stock correlates to the benchmark, but has potential for higher volatility. And that's what you want. If you're day trading, you want those betas to be around 1, a little higher, a little lower, doesn't matter. But you want to have a beta closer to 1 than closer to 0 or closer to -1, because you want that high volatility and you want high ranges and you want high volume if you are going to be day trading. Now, actually looking at the elements of a company's financials. So this is different. I showed you guys the key metrics of, looking at the company's ratios, right? Which is more important for kind of determining certain valuations. But this is actually going into their books and seeing what most people don't even care to look at. So this is the elements of a company's financials. You're actually going into their books and seeing. All right, so the income statement, the balance sheet, and the cash flow. These are the 3 components that you'll be looking at on Yahoo Finance or whatever you guys use to determine each of these elements. So what is an income statement? Well, there's 4 key metrics of an income statement. There's revenue, there's expenses, there's gains, and there's losses. So an income statement indicates a company's financial performance over a given period of time, whether annually or quarterly. Net income equals total revenue plus gains minus total expenses plus losses. So revenue and gains. Looking at this same income statement, you're going to see a section for revenue and gains. You have operating revenue and you have non-operating revenue. So operating revenue is revenue generated from the sale of product or activity. So if you have a lemonade stand, then operating revenue is literally when you sell 1 lemonade. That's your operating revenue. The non-operating revenue is generated, it's revenue generated that is not related to sale of product or activity, such as rental property income or partnership income. So if you have a lemonade stand and you have a friend who wants to get in on this business, and then you open up another lemonade stand, and now that friend is paying you rental property income, boom, that's non-operating revenue. So that's not related to the sale of your actual product or the business activity. That's non-operating revenue. And then you also have your gains. So it's net money made from other assets outside of business activity, such as selling of vehicles or land. So, if you sell that other lemonade stand, then that is going to be listed on your gains on the income statement. Also on the income statement, you have expenses and losses. So primary activity expenses and then secondary activity expenses. So your primary activity expenses are incurred from operating revenue like employee wages, sales commissions, expenses for utilities, etc. I mean, that's kind of self-explanatory, If you have a lot of business on your lemonade stand, you just can't handle it. You need someone to squeeze more lemons for you, then that you have to pay your employee, and that is your primary activity expense when you pay your employee. Secondary activity expenses are non-business related expenses such as interest paid to loans. Self-explanatory. And then losses. Expenses toward loss, making sale of assets, one-time costs, or lawsuits. So you have your lemonade stand, and then all of a sudden Walmart sues you for selling their product or whatever, right? That lawsuit will go on the losses section of your income statement. Other component of a financial analysis is the balance sheet. So what is a balance sheet? A balance sheet reports assets, liabilities, and shareholders' equity. Balance sheet evaluates a company's capital structure. So it's assets equals liabilities plus shareholders' equity. Assets can be cash, inventory, property, whatever it may be. Liabilities can be rent, wages, utilities, taxes, loans, etc. So, if you guys have $5,000 in your bank account, that's an asset. If you're currently paying rent on an apartment, that's a liability. If you're still paying off your car, that's a liability. If you're paying utilities for your apartment, that's a liability. If you have a student loan, that's a liability. So shareholders' equity is retained earnings. Debt to equity ratio can be derived from balance sheet as the equation is total liabilities divided by shareholders' equity. What is cash flow? Cash flow is the net amount of cash being transferred into and out of a business. A company's goal is to create positive cash flow and maximize long-term free cash flow. 3 types of cash flow are operating, investing, and financing. So operating cash flow is cash generated by a company's main activities. Investing cash flow is purchases of assets or other business ventures. Financing cash flow is proceeds gains from debt and payments made to by the company. Now, why is it important to have positive cash flow? Well, let's say coronavirus happens, right? And you're a company and you don't have any reserves. Something happens dramatic to the economy, something happens dramatic to the business, then maybe you'll need to dive into those preserves, right? To this cash flow, this positive cash flow, that free cash flow that you have available, and actually use that money to sustain your business if you're not, if you don't have the actual revenue and the profit to sustain during that period of difficulty. So it's very important for a company to have positive cash flow just in case. So positive cash flow is company adding to cash reserves for future growth potential. if you need to grow, you need to expand, you need to buy other land, you need to buy other property, hire more employees, then you can use that positive cash flow for that future growth potential. It's cash reserves. It's very essential. So free cash flow is cash a company generates after all outflows. The higher the free cash flow, the better. So this is what an income statement looks like. This is from Apple. This is just an example. And you can see this is a annual income statement, because if you look at the top of the columns, you'll see 2019, 2018, 17, and 16, and it shows you at the top. So this is your breakdown. You have your total revenue, cost of revenue, gross profit. So this is all of the revenue. And then you have your operating income. So like I said, there's 4 different parts of this actual income statement. So your revenue, your income, your losses, and then here you go. So after all this, oh, by the way, and this is multiplied in thousands. It shows you that on Yahoo Finance at the top. These numbers are in thousands. So the total revenue for 2019 was not 260 million. It was actually 260 billion. So you just add 3 zeros. If it says all numbers are in thousands, you'll just add 3 zeros. So this is 260 billion was Apple's revenue for 2019. And then their actual net income after all of expenses, right? So profit, income, loss, their net income was 55 billion. So even though the revenue was 260 billion, they actually made 55 billion on that. And then down here, you can see their EPS, and then their EBITDA down here. And it is for each year. So you can actually see that, from 2016, they only made 45 billion. And then this past year, they made 55 billion. So they're making more and more and more each year. And then here's what a balance sheet looks like. This is also on Apple, but like I said, it's assets, liabilities, and then stockholders' equity. So you can see at the top, you have your assets, and this includes everything. It has inventory, other assets, net receivables, cash, and then your liabilities down here. So, they had 338 billion in assets in 2019. They had 248 billion in liabilities in 2019. And their total liabilities and stockholders' equity, there you go, 338 billion. So this is what a balance sheet looks like for Apple. And then a cash flow. These aren't that hard to read. Remember, I said there's 3 different kinds of cash flow. There's operating activity, investing activity, and financing activity. And then your free cash flow down there at the bottom. So these really aren't that difficult to read. You just kind of have to look through. But you can see everything that I talked about is on these columns over here to the left. And you can see, their free cash flow, right? So in 2016, they had 52 billion. And then this past year, they're looking at $58 billion in free cash flow. And remember, I said the higher the free cash flow, the better. So that's amazing, to have 58 billion in free cash flow. That's amazing. So key takeaways of fundamental analysis. Begin by looking at the 5 metrics we discussed earlier in the lesson to find strong, healthy companies, potentially undervalued ones. Use the income statement, balance sheet, and cash flow to determine the financial stability of the company, both in the past, present, and future. Understand that these metrics are to be applied over a long-term basis, and acting on a low PE ratio or a high PE ratio, for example, over a short-term basis may not work out in your favor. So everything that I talked about today is about long-term. Short-term doesn't mean anything when you're looking at the fundamentals. Always remember, stocks can only deviate from their fundamentals for so long. If a stock is way overvalued in the books, eventually the price per share will reflect and the stock will drop. If a stock is way undervalued in the books, eventually the price per share will reflect and the stock will pop. Use fundamental analysis as a basis to taking stocks long or short on a long-term basis. as the true measure of a stock's price will always fall back to fundamentals in time. So this is, using fundamental analysis and understanding how a company is valued, understanding why the stock is valued where it is really something to be focused on a long-term basis. So, if you're looking to buy a stock and then sell it in 5, 10, 20 years, then this is for you. And it's very essential. I mean, if you really want to start building your retirement account, you want to get into the finance industry and understand how everything operates, then you have to get a solid understanding of fundamental analysis and how to, value a company. But that's all I have for today. So I'm going to pass it off to Unraveler now. I hope that made sense. If not, I'll be around for questions after the class. Thanks.
Thanks, Mike. Good evening, everyone. Hope you guys are having a good evening and a very good trading day. Welcome to day 5 of AMU University. So today I'm going to be teaching you about earnings report, what it is, and what is the significance of it, and how as traders and investors do we consume the earnings report and act accordingly. Okay, it's going to be another lesson on fundamentals. I'll be briefly touching on a few things that Mike also covered. So it's a nice class and you guys can kick back and listen to me, take notes, and learn a lot. Okay, let's get started. So the table of contents for today's lesson, first I'm going to be giving you an overview of earnings season. How do you find out when companies report earnings? How to research companies for earnings, planning and stock selection process, trading strategies for earnings, and lastly, do's and don'ts. All right, let's get started. Earnings season overview. Earnings season is one of the most anticipated periods in the financial year for the markets. It refers to the months when most publicly traded companies release their quarterly earnings reports. So if you have been in the trading world, like the finance side of things, like once you started following the finance news, you would hear every once in 3 months, you would hear everyone's getting buzzed around earnings. You would see a lot on the news saying that company XYZ reported so many numbers, the stock price rallied or tanked, it cost so and so, some so and so catalyst happened, and you would see a whole wide variety of news. If you tune into especially websites like CNBC or just watch the TV, you would see a lot of people talking about it, what it is, what it means for the company, what it means for the sector, and what it means for in some cases, the economy too. And so as a trader and as an investor and as a Wall Street, anyone working in Wall Street, this is one of the most anticipated periods in the market because whatever the companies promised, they have to actually produce the results during earnings season. So they will give out all their performance details. So if you go to school, you are getting a report card, right? Just like that. All these companies are going to be reviewed for their performance in the previous quarter. So that's the season where companies actually are judged for their performance. So companies release the most recent quarter's performance and issue guidance for the current year and full year. So during this time, we have several statements. The company release their income statement, they'll update their balance sheets, show what's in the books, and apart from that, they will issue guidance for the current quarter and full year. So what does that mean? Guidance for the current quarter meaning they're just going to tell if everything is going according to plan, and then in that case, they are not going to revise their future earning estimates. But if something's not going according to plan, they're going to give out more clarification and update their projections for the current quarter and the full year. So in the cases recently, so today FedEx reported they refused to give guidance for the fiscal year 2021. FedEx reported earnings, they beat their earnings today, but the company refused to commit to a number for the next financial year. I mean, that makes sense, right? So currently they are getting a big boost because because of all the related COVID related, demand surge that's going on all the shipping carriers. They're making a lot of money. They've increased their shipping rates 3 times in the past year. So all these tiered shipping price models have really helped improve the company's margin. They're making a lot more money now, and it's actually starting to show in their balance sheets, and their company is actually turning a new leaf. But they are refusing to commit to a number for the next year because they don't know what's going to happen next year. Are we going to get a vaccine, or are things going to demand going to slow down? They don't know, and honestly, that's why they are not committing to any numbers. Because if they commit to a number, Wall Street's going to price in a certain expectation for the stock, and if they fail to deliver, the stock's going to take a beating. So that's why they don't want to commit to all make false promises. Okay, so these are the kinds of things that companies do during earnings releases. Earnings releases, ER, commonly known in the finance world, ER occurs 4 times a year at the end of each quarter, generally in January, April, July, and October. So let's take a look at this example here. So we know that it occurs 4 times a year. So in the case of Apple, if you go to any website like investing.com or Yahoo Finance, if you click the company, you can see when the company is reporting their earnings release. So in the case of Apple released earnings for quarter 1, that is the period ending 3/20 on 4/30. So what does that mean? So when you see a company saying which period that they're reporting for, so in this case, Apple reported the earnings Q1 for period ending 03/2020. So each quarter represents 3 months. So 03/2020 is the period end date. Then they're reporting for January, February, and March, the first 3 months of the year. And they reported the performance for the first 3 months of the year on April 30th. That is a month later. So that's how you read the dates. So whichever period you're seeing, they usually the company usually reports a month after the period end date. So in the case of the second quarter, we see the period end date was 06/2020, and typically after a month later, Apple released the Q2 earnings numbers. So the next time you can expect the next period end date is probably going to be 09/2020. So in 10, you're going to see in October, you're going to see Apple report the next quarter's earnings. Okay, and you can also see that the EPS was not forecasted. Okay, so that's another thing that you always notice when you go to any one of these websites. So hope that the basics is clear. Earnings season is just a period where all these companies release their the previous quarter's earnings results, all the financial performance. They're going to release their income statements, balance sheets, and they're going to issue current quarter's guidance and future quarters guidance as well. Okay. All right. Timing of earnings releases. Now, most companies release their quarterly earnings report when the market is closed. So you may wonder, why does this happen? So if the companies actually release their earnings report when the market is open, as traders, you can actually trade that news and make money in the process. Well, that is true, but these big companies, they don't want to cause that kind of volatility in the stock. So if as an investor you get a report just thrown, if a company releases a report midday, what's going to happen is, without even reading the whole report or without hearing the details behind the numbers, people are going to react. Investors are going to react. Everyone knows that investors react and then think. So they don't want to cause that kind of panic, because algorithms and investors and traders, they can cause a lot of volatility in the stock, and they don't want to cause that kind of volatility during market hours when there's large volume in play. So that's why most of these big corporations, they release their earnings report when the market is closed. That's the only reason that they do that. So this typically means that the quarterly reports are released before the stock market opens, that is around 7 a.m., or after the stock market closes, that is around 4 p.m. Now, that said, there is no rule that's enforcing any of these companies to release their earnings after market close. You see a lot of small cap companies release their earnings report during the day, and that happens. And there is volatility in the stock, but those stocks are small cap for a reason, and those stocks are used to that kind of volatility. And if you're a trader trading small caps, you can trade off those reports. Okay, so that's the timing of earnings releases. Now, what is an earnings call? This is another term that you may or may not have heard. So every earnings release, there is a conference call or a webcast that's hosted by the management of the company, of the publicly traded company, to discuss the financial results achieved in the most recent quarter. So usually the management of the company, the CEO, CFOs, and the general, the administration, they host a call where they invite all the analysts from different banks. They invite some of the insider investors, some general investors, as well as the media to discuss how the company did, to display their results, to show to showcase their performance and actually give out statements. So they invite everyone, make it into a big event. So if you follow companies like Apple, Tesla, it's almost like a social media event. They invite a lot of people. It's almost like they broadcast it online, and you as an investor can watch it. You can see all these CEOs and CFOs. They give out big statements. They talk about the future plans for the company, what they're going to do. If it's Apple, they're going to talk about what they're going to achieve in their, let's say, in one of their iPad streams or whatever, the iTunes, what they're going to make changes to their revenue model, how they're going to introduce what, and how are they going to achieve even more advantage. So you know how it goes. They're trying to trying to sell their results and make sure that investors stay with the company and promise of a better future for the company. So that's how the typical format of the earnings call goes. They've discussed the financials. Then we will have a lot of discussions on guidances. And lastly, we will have a separate section for questions where all of these attendees can ask the management questions. They may ask to clarify earnings numbers. They may ask to clarify guidances. They may ask if they have any kind of expansion planned, or are they planning to close out some stores, or whatever the case may be. They may ask, where is the company going to go? And many times, so sometimes companies don't actually meet their numbers, and they may face stiff competition. They may face some kind of slowdown due to the economy or whatever. So these questions asked by these analysts will be to drill down and get to the bottom of, it's not going to be an easy meeting every time. So they will get tough questions, and based on the answers that we receive, the stock's going to react in various ways. Okay. So that's the format of earnings call. And every company usually has a webcast. So you as an investor, you can just register yourself on the webcast on the investor relations page of the website. Just go to their page. You can just type in your name and hit join. You should be able to watch the earnings call live. Everyone can do it. Most publicly traded corporations make it easy so that anyone can join and listen in on the call. And if you miss it, always there are recordings available mostly on the website of the company. You can go in and listen to it later. Okay. So that's the format of the earnings call. Now, let's jump onto the details now. Now you know what an earnings season is, what an earnings result is, what the format is for the earnings result, what is an earnings call, and what is discussed there. Now we know all of that. Now, why as an investor should you follow a company's earnings? This is the question everyone gets. Most of us are traders here. This is a trading course. So you come in as a trader, you learn how to read price charts, you learn how to read trends, you learn how to plot your support and resistance line, you learn about indicators, you set your levels, you play you take your day trades and swing trades, you make money. That's all well and good. But at some point, you will want to learn about fundamentals and know about earnings and what goes on to evaluating a company and all of that, because at some point you will want to start investing, researching companies, investing in companies, take on long-term plays. So for all of that, you need a bit of fundamental analysis, especially when, even as a trader, as a long-term trader, if you are trying to get into a stock, buying at support, and let's say you plan to hold for 3 months or 4 months, you want to be sure about the fundamentals of the company, because although you know that as technically the stock price can rally, fundamentally, if this company's balance sheet and income statement is trash, it's not going to rally. So the chances are there's more downside to it, even though you got in at a cheaper entry. So it's always good to know a little bit of fundamental analysis and know how to research companies. So So why you as an investor should follow company's earnings? So it gives investors insight into how well a company's business is doing, at least in terms of figures, in numbers. Numbers always justify even more than promises. So a lot of these companies, I know a company called RH. So their CEO is called Gary. He he can sell anything. He's a great salesman, and if you attend one of their earnings call, you would think that that company is just going to go to $10,000 per share price or something like that. He's going to sell everything, but at the same point, you as an investor can listen to something like that, but you want to see something in numbers as well. The company is doing good, so I just hate that company, but uh, figuratively, you want to see you want to see the company really doing all good in terms of figures, not just promises based on the business's CEO. So you as an investor should be looking at figures. So that's one of the reasons why you should follow company's earnings. And the second reason is it helps you as an investor to make sound investment decisions based on current earnings and future growth potential. Now, as an investor, you may hold XYZ company share and the company did well on the current earnings report. But if you don't see the stock price, if you see the stock price just staying stale at a certain price level for a long period of time, you may want to question your investment decision. And you can only do that based on the finance numbers. And if the company's current earnings is good, but they're not showing any growth potential, then it may be a time for you to take your investment elsewhere, take your money elsewhere and put it in something else that's actually showing good growth and it's going to give you a good reward in the future for your investment. Now, just because you stay in a stock for a couple of years doesn't mean that you should put your money there and just keep holding. Sometimes the company's fundamentals change all the time. 2 years ago, Tesla was not even making a profitable quarter. Today, they have made four consecutive profitable quarter, and analysts who said that Tesla was going anywhere, they're going to go bankrupt and whatnot, they're like uh, they're like in hiding right now because Tesla has defied everyone's expectation. Sure, it's overvalued, but a company can stay overvalued and just keep evolving their fundamentals as they keep growing. And so always know that fundamentals can change over time. And if the company that you've invested in is no longer producing the same kinds of result or is no longer showing the same promise that you once saw, it's time for you to take your investment elsewhere. So earnings numbers, especially the current earnings and future projections, will help you make sound investment decisions. And you're going to make these decisions based on fact, not promises based on the CEO's opinion or the analyst's opinion or someone else's opinion. You're going to be basing those decisions on facts and figures. Now, earnings reports are highly anticipated because they can cause major price swings depending on the earnings numbers slash guidance provided. Now, this makes sense, right? We all know that nothing moves the stock market more than news. An earnings report is the most anticipated news because everyone is interested, not only retail traders, institution, banks, analysts, everyone is interested in the earnings reports. And obviously, it's going to cause huge price swings in the market. Now, because of because of the potential for relatively big price swings, an investor's position can be heavily influenced by how well a company's earnings report is received by the market. Now, if you own 1,000 or 2,000 shares of Apple, you are a heavily invested investor, and based on how Apple's report is perceived, you stand to make overnight big gains, or you're going to take a big loss overnight. Of course, it's not a loss until you sell, but still, your stock is going to take a beating, and if you actually done your research ahead of time, you may have done proper hedging, or you may have taken some profit off the table. So it's a very big time for an investor, especially because you're putting your portfolio out there. You're putting it out. Your portfolio is going to take some volatility, and it's good for you to protect your portfolio when during moves like this. Now, a number of things can happen during earnings releases. If the company beats earnings expectations, there could be a significant move to the upside. Company beats earnings, everything is well and good. They promise good things, everything in the call went well, the stock price is going to move to the upside. FedEx did well today, they're up 9% after hours. In contrast, Failing to meet expectation and earnings miss could potentially result in a significant decline. Of course, it's not every time is a company going to beat earnings. There are many times where a company is not going to meet expectations, which will result in an earnings miss. And this could potentially result in a significant decline. I say potentially because based on earnings releases, a stock can move to the upside or downside, but it all depends on how the market receives the report. You as an investor may think that, oh, the company beat earnings, so it's going to go up. But there might be something in that report or something that is said in the conference call that the general market, that is Wall Street, may not like. And if that happens, the stock price is going to react in an opposite way. So earnings are reported as being in line. So sometimes third option is if everything meets expectation, there can be no move in the stock at all. So anything can happen, and it all depends on how the market receives the report. It doesn't matter on whether they beat the earnings or they miss the earnings from a figurative standpoint. Okay. Now, as a trader, are we interested in earnings report? Of course we are, because the potential for a stock to move by a large price point in response to an earnings report can create active trading opportunity. So Zoom recently reported earnings. The stock, I think, rallied like 40% or something like that. And the next day it presented huge volume opportunity. There was great volume and presented great trading opportunity. And if you were a trader, like taking part in such a liquid on a stock that was so liquid on a given day, it's going to create a very good trading opportunity for you. And as a trader, it's something that you want to trade. Okay. Now, how do you find out when companies release earnings? Earnings release dates are usually posted in investors relations page on a company's website. But a consolidated version of a weekly and monthly earnings can be obtained from most stock trading / news platforms. So these are the most popular platforms where you can actually go to and check out when companies release earnings. Number one, investing.com. It's one of the more popular website. Earnings Whisper is another one. CNBC, MarketWatch, Seeking Alpha. And if you have any of those paid sources like Benzinga or whatnot, they also are going to give you information on when companies report earnings. Now, all things said, these platforms sometimes post an anticipated earnings release date, meaning sometimes, so the original release date, the real release date of our earnings is going to be posted on the investor relations page of the company's website. What these platforms do is they just fetch that information and put it into their own calendars. And sometimes what's going to happen is the company may have not released the earnings release date. So what these platforms do is they just post an anticipated earnings release date calculated based on the past year's release dates. So if you're an investor and you're looking to trade the earnings or the run-up leading to earnings, make sure that you get the date right, and always make sure that what you're looking at is an anticipated date or the real date. Okay, it's something that you can miss, and it may actually cost you money. So it's better to be sure of, if you're trading in earnings, be sure that the date is right. Okay. So these are screenshots of Earnings Whisper. It's a very nice website. You can actually get a calendar view as well as a detailed daily view. So on any given day, you can go click on the date and you can see the list of companies reporting earnings. You can see what the earnings per share estimates are, what the revenue estimates are, and you can see what time they're reporting, whether it's pre-market or after hours. And if you click on one of these links, you're going to get a more detailed view. You're going to probably get an analysis, an analyst opinions, and so on and so forth. And once the company actually reports, you're going to see an updated view here. And towards the right side, you see investing.com. This is a much more cleaner view that I like because it's going to give you, you can actually filter any of these dates over here. So you have a filter option here. So what you can do is you can select that. You can filter by country. You can filter by sector. You can filter by market cap. So the reason I say that is because, so let's say, and on any given week, a company, you're interested in playing tech earnings. So typically, there are thousands and thousands of companies out there in the market, and typically on an earnings week, on a good earnings week, you will have like 4,000, 5,000 companies reporting earnings. You may not have heard of all those companies, and all these websites, they don't show all the companies by default. They just show the most popular ones. So for example, if Apple, Amazon, Facebook, and Google are reporting that week, they are going to be the top story. They're going to be the headliners. But you may be holding a stock of some no-name company, and you may be interested in playing that small niche sector. So if you wanna research that sector, you can come in, use one of these filter options, filter by market cap, filter by the sector, and then you will see the more finer result here. So you can play around. It's a very neat tool. I like investing.com, and you would get all the information that we just discussed. Okay. Now, now that we've completed a little bit of the basics, now we're going to talk about how we can actually go about researching companies. So we know about earnings now. We know that a company reports earnings, and stock price can move in various ways. It's very important for an investor to know when a company is reporting earnings and what they're reporting. So how can we go about researching, that is preparing for earnings reports? So all traders at some point in their trading career will want to trade an earnings report with the dreams of making huge profits. I mean, who doesn't? Like, the stock price moves 10% or 20% overnight, your option's going to gain like 500% return. I mean, making a gamble like that is not insane. I mean, especially if you're just using like $200 to make $2,000. I mean, that's a great return, right? Just for an overnight play. Of course, all traders would want to play an earnings report at some point. While the saying goes, earnings are gambles holds true, the probability of success can be increased by performing due diligence and by using a sound trading strategy. Of course, if you're just blindly gambling, one or zero, just binary gambling, you think the stock's going to go up or down, just bet on one side, hope that it goes right. That's gambling. But if you're actually doing a little bit of due diligence, your probability of success is going to increase. Even by 1%, it's worth effort. Now, how do you go about researching and analyzing stocks for earnings? So I'm going to dive into my process on how I actually prepare for earnings. So usually I do play earnings in Q3 and Q4, but this year I put a stop to it. Maybe because of coronavirus, no one really knows what these companies are going to report and what the market's pricing in. So it's kind of hard to figure out what's going to happen, how the stock's going to react. So I just put a stop to it. But I do have a process for researching companies. So in step number one, I select a list of stocks for analysis. So select a list of stocks you're interested in at least 2 to 3 weeks prior to earnings release date. So the reason for doing that is because sometimes you will have a few companies that you're interested in trading the earnings, but not all the time will there be a good trading setup, that is a good trading risk reward play to play the earnings result itself. So sometimes you want to play the lead up to an earnings. What does that? What does the lead up mean? So let's say you're interested in playing, let's say stock Nvidia. Nvidia, you're interested in playing. You're interested in Nvidia. You think that the stock is going to run. There's hype, a lot of gaming consoles coming out. There's a lot of deals happening behind the scenes. You think that Nvidia is going to gain like $50 to $100 leading to earnings. So in that case, you may get a long dated contract and trade Nvidia leading to earnings. Just buy low, just hold those contracts, and as volatility continues to increase, your contract's going to gain more value, and as it gains intrinsic value, you're going to gain more and more value. So sometimes the run up can be more rewarding than the actual earnings result itself. So sometimes the run up may be so huge that the earnings is already priced in, and the stock makes a no move after hours after the earnings are released. So it depends on what kind of move you're expecting from the stock and what happens 2 to 3 weeks prior to earnings release. So depending on the strategy, you want to be prepared for either or scenario. So that's why you should always be prepared at least 2 to 3 weeks before the earnings release date. So the first step is select the list of stocks you're interested in. So if you think that October you're interested in trading Apple, just prepare for it 3 or 4 weeks back and see what happens, see what kind of strategy are you planning to apply. I did Facebook earlier this year where Facebook gained like $30 leading to earnings. It was a nice play, and they actually beat earnings and rallied $10. It was a nice play on Facebook that we did earlier this year. And anyway, so The reason for selecting 2 to 3 weeks is because this way you'll have enough time to research the company and formulate an effective trading strategy. You can research stocks by going to one of the websites like marketwatch.com, CNBC, Yahoo, etc. There are a lot of stocks. Just go there. Just showed you how the calendar looks. So if you're interested in tech earnings, go to that week, see which companies you're interested in, write them down, and write the dates down, and then plan them out. All these websites are going to be you're going to be a source. You can go to the websites and get all the information that you desire. And then the next thing that you want to do is look into the recent analyst upgrades, downgrades, price target revisions, insider buying and selling of shares. So this information is also available on most of these websites, but it's also available on finviz.com. And if you have a pro platform like Benzinga or Bloomberg, that's also available over there. So the reason for looking at analyst opinions is you can clearly see 2 to 3 weeks prior to the earnings release date. Once the company announces their dates, you can clearly see what the analyst sentiment is, because sometimes they will downgrade a stock because they don't think the company is going to make money. Sometimes they may upgrade a stock thinking that the company has great upside potential. So based on these upgrades leading to earnings, the stock may actually go on a run. Okay, so sometimes there may be manipulation involved here because sometimes the analysts may downgrade it so that they can accumulate cheap shares. So you just have to think into perspective, because a good company may not do manipulation, but there are a lot of analyst firms out there, a lot of finance firms out there, and some of them do manipulate the stock. So be careful over there. And you may also want to look at price target revisions. A lot of banks issue price targets for stocks, and what the price target is going to be based on one of their rationales. So they may have a lot of theory that, for example, I'm just giving this out there. If Tesla achieves this so and so's sales and by the end of 2022, and they sell this many batteries and solar panels, we think that an analyst came out and said last year that we think Tesla stock's going to be like valued at $7,000 by the end of 2022. So that's one of those targets that these are the targets that the company actually issues based on one of their theories. And the company actually, most of the time when they upgrade or downgrade a stock, you will see a revised price target as well. So all these is going to help you form your directional bias. Why do you need to have a directional bias? So 2 to 3 weeks prior to earnings, you don't know the stock is going up or down, and all these small information is going to have somehow tilt you in one way or the other, and you may want to look into all of this and note it down. And another thing, very important thing, is insider buying and selling trends. So if you constantly see an insider buying shares like 1 month prior to earnings or 2 months prior to earnings, then that shows that the insiders are confident that the company has good upside potential. If not now, it's in the near future. And alternatively, if the company's insiders are constantly selling shares, leading to earnings, that shows that the insider sentiment is not that great. Okay, so these are the things that you want to note down. First step, especially when you're researching companies, just take a piece of paper, write down the list of names that you are interested in, and write down all the information that you gather out. That's step number one. Step number two is analyze the company's financials. Look into the company's financial health by reviewing their income statement, balance sheet, and cash flows. The goal is to compare quarter over quarter and year over year numbers for revenue, net income, and cash flow. So I'm going to teach you a little trick here. So when you look at an income statement and you see all the numbers, sometimes you don't know what you're looking for. You don't know, is this good or is this bad? So I'm going to tell you from an earnings standpoint what you need to be looking for. Income statement provides an understanding of the revenues and expenses of the business. Revenue stands for what the company makes, and expenses stands for what it is that they spend to keep the lights on the business. Okay, what they make is revenue. What it is they spend to keep the lights on is what we call as expenses. It is a good sign when a company shows revenue growth consistently beating expectations. So every time an earnings scheduled, there's going to be an expected number for revenue. And if a company ABC constantly has a habit of beating expectation, and they constantly show good revenue growth year over year and quarter over quarter, That's a good sign. That's a sign that the company is doing really good in their core business. Decrease in operational expense. So operational expense is the money that they use to spend to keep the lights on in the business. If the company is actually spending little less and less to keep the lights on, that is, they don't spend too much in operational expense. That is also a good sign. But good companies always tend to spend a lot in research and development, especially in quarter one and quarter two of the financial year. So if you're looking at the income statement and you see that the revenue is good, that line checks okay, but operational expense, why is that after Q4 of the previous year, Q1 has operational expenses almost doubled what it is that the company is doing? Because of the Q1 operational expense, the net income has like dropped like crazy. Why is that? That's a bad sign. So you shouldn't jump to conclusion like that. So what you need to do is know that good companies always spend a lot in research and development. So go to the previous year and see what happened. And if you actually read the company's earnings report and see what they said during the earnings call, you will see that the CFO explaining why that the operational expense was high. For example, Amazon, 2 years back, I think it was 1 year back, remember that they dropped like $200 or something like that on earnings. I think there was like 1,700 or something like that. From 1,900, they dropped like 200 or $250. So the reason they dropped is because they were implementing 1 day shipping, prime shipping, and the operational cost for that was huge. It took a huge hit on the company, and it dropped their bottom line, meaning the profits that they generated that quarter was not that great. And the guidance that they issued was Bezos said that they are going to lose a lot more money, but this program is working, so we may not see some profitability for the next few months. So that's what they said, and the stock actually took a big hit. Wall Street reacted, but then they eventually gapped up pretty quickly. But good companies, they may spend a lot of money. And in the case of Amazon, the next quarter, they reported exceptional e-commerce sales, and they actually rallied $300 or something like that. I think people made like 1,000% return overnight on that Amazon earnings beat. So good companies, they may spend a lot. And if you notice that the operational expense is high in the first 2 quarters, just know that most of the time they make up for it by generating more revenues in the following quarter. If they spend a lot in the first 2 quarters, they will make up for it in the following quarters. That's what good companies do. Okay, so that's something to note. That so don't always jump the gun when you see something a big number on the operational expenses side of things. Okay. Now, I like to play earnings results in Q3 and Q4 of the year because good companies always tend to perform better in the business end of the year. The first 2 quarters, they like to spend a lot. They internally they'll try to improve their business. They may expand. They may acquire some companies, whatever it is. They spend a lot. They will compromise on the bottom line. But Q3 and Q4 is the business end of the year. So Wall Street and insiders and investors, shareholders, board of directors, everyone of the company, everyone will want to see the company perform better. And Q3 and Q4 is when is the business end of the year. So that's when all the companies will strive to do better. So if you're trading earnings reports during those quarters, chances are the company is going to produce a very good results, and it's going to make a good move. Now, we discussed about how decrease in operational expenses is good. It's a good sign, but good companies may spend some money in the first 2 quarters of the year. But if you notice a constant rise in operational expenses, but don't see much revenue growth. So good companies, if they spend a lot in the first two, they may make up for it in future quarters, evening things out, making more money, growing as a business, and performing better. But some companies, they spend a lot of money to keep the lights on, but you don't see any revenue growth in the current quarter or the previous quarter or the future quarters. So that's a bad sign. So then the company may be struggling to improve their margin. So this is a very bad sign. So we see a company spending a lot, but they're not making any money. Just simple math. They're not going anywhere. They're not producing enough profits. And this is a very bad sign. So this was what was happening for FedEx before. They were spending a lot of money. So the stock was trading at 150 or something. They were spending a lot of money. The shipping rates were not great. They were having troubles with Amazon. They were having terrible margins. and the demand that they were struggling to keep up demand with all the competitors and international customs laws. But the CEO actually changed, and they are producing good margins now, and the stock price is reflecting that change here. So if you're looking for a company and you're trying to do fundamental analysis, looking at the income statement, and you notice this, know that that's a bad company. For example, I'm going to give you guys a homework. Go to Yahoo Finance or whatever website, look up Hertz's income statement, the company that went bankrupt. You will see that how much money they were spending, and look at Neiman Marcus, any of the companies that went bankrupt. You will see that they were spending a lot of money, but they were not pulling in any revenue growth. And quarter over quarter, year over year, they started to accumulate more and more debt, and eventually they had to file for bankruptcy. So that's how all the companies that goes bankrupt, it starts small all the time. Good companies, they will make up money and they will eventually put a stop to increase in operational expense. But bad companies, they just keep going and going and going. Okay. Now I say this because earnings doesn't always have to. It doesn't mean that you always have to play the upside. There can be good value in the downside as well. If it's a very bad company, you see very bad. You don't see good value in paper, and fundamentally the company has a very bad business model because of competitors and whatnot. There may be good value playing the downside as well. Okay, so that's some things that you can look for in an income statement. And net income growth is the most key important metric in the income statement. And net income growth is used in the calculation of EPS. EPS is earnings per share, which is another metric that the companies release apart from revenue, and is to measure the company's profitability. So it can be calculated by taking the difference between total revenue earned and total expenses. Revenue earned is the money that they bring in. Expenses is the money they spent. Subtract that and you'll get the total profits. Okay, so that's the income statement. Next is balance sheet. Balance sheet provides the detail of the company's sources and uses of funds. So every company is there's going to have a lot of money moving around different parts of the business. Balance sheet is going to give you the current status of those funds. A company's balance sheet can provide information on current assets, liabilities, and shareholders' equity. It is a good sign when companies' assets grow and liabilities decrease over time. I think Mike just showed you Apple's balance sheet. They have a lot of cash in hand, liabilities are non-existent almost, and that's a very good balance sheet. Apple can literally buy out any company. Supposedly, let's say Apple, their iPhones fail, their business model fails. It's not going to happen, but let's say they cannot sell a single iPhone going forward. If that happens, Apple is just going to move into a different sector because they have the money to do so, and then become a major player in that sector and then produce more cash. Because that's the kind of power that Apple's balance sheet has. They can buy over companies, they can take over industries, and they can become a major player in that industry and bring in cash. So that's the kind of power a good company has. And as a good company, you want the company's assets to always grow. You don't want a lot of liability for the companies to have. And if they have good cash, having reserves of cash, that is assets in hand, indicates that the company has enough liquidity to meet all debt obligations. So supposedly they have debt, the company has good debt, but they have enough cash in hand to meet all those debt obligations, then the company is in a good place. Now Hertz, on the other hand, which I just said, they didn't have enough cash in hand, and the debt continues to increase. They had a lot of liabilities in their books, and the company had to file for bankruptcy. So these things just happen, and everyone can foresee it. That's why fundamental is so cool. You can see the stock rally all you want, but if the book is trash, you know that whatever goes up is going to come back down, and it's going to give you a good trading opportunity there. Okay. So third is cash flows. Cash flows, on the other hand, tracks the movement of cash in the business. It shows the cash generated from operations. It shows the cash inflows and outflows from investing activities. So the company makes a purchase of properties, equipment, whatever it is that they're used to run the business. You can see all the cash activity here. If you see cash inflows, outflows from financial activities, so stock buybacks, a lot of companies do stock buybacks. It is to reduce the total number of outstanding shares in the company. Apple used to do it. Airlines, all the airline companies used to do it. That's why there's a huge huge controversy right now because the airlines are requesting a bailout from the government, and a lot of investors in Wall Street and a lot of politicians even are against it because all these airline companies last few years, instead of paying all their employees, what they did was they was used to buy back all their stock because they just want to reduce the outstanding shares. They want to make sure that the company has a solid financial backing, sorry, solid uh, strength in the market, because less outstanding share means more strength in the market. So they did all that instead of paying all their employees. Now they're in a dire situation. They want to bail out from the government, but the government's against bailing them out because they wouldn't agree to stop stock buybacks. It's another important controversy, but cash inflows and outflows from financing activities, if they do any stock buybacks and insider transactions and everything, you can see that recorded here. Okay. So the next important figure that we just discussed was earnings per share estimates. Like revenue, all companies, when they report earnings, you'll see two bottom metrics. One is earnings per share estimates and another is revenue. And earnings per share is a measure of how much profit a company has generated. It can be defined as the portion of a company's profit that is allocated to each outstanding share of its common stock. So this figure is available in the balance sheet. That is the outstanding shares. That's the total number of shares that's out there for the company. It's available in the last line of the balance sheet. You'll see the total outstanding shares at the end of the balance sheet. Now, how can you calculate earnings per share? In the next slide, I will exactly teach you how to calculate the earnings per share, but here's the definition. It is calculated by taking the difference between a company's net income. So in the income sheet, you will see net income in the last line. That's the bottom line. And the dividends paid for preferred stock. So we take the difference between net income and dividends paid and divide it by the average number of outstanding shares. That will give you the earnings per share estimates. Okay. Don't worry if you don't understand this now. Next slide, I will show you a real example so that you can connect the dots. So why is earnings per share relevant? What is the significance of it? Good earnings can cause stock prices to rise. And when they do, investors make money. If a company has high earnings per share, it means that it has more money available to either reinvest in the business or distribute to stockholders in the form of dividend payments. Either case, it's a win-win for investors. So this is fairly straightforward. If a company has good earnings, they're having more money the business is generating more money, they can decide what to do with that money. If they're barely producing any margins, they're not going to have enough profits in hand to actually reinvest in the business or distribute to stockholders in form of dividend payments. So if a company produces lots of profits, they can do one and two things. They'll either reinvest a lot in the business to make it grow even more so that it can produce even more profits. And if it produces even more profits, the stock price is going to go up and investors will make money through stock. If the company actually has enough earnings and they decide to distribute half part of that in the form of dividend payments, if the company produces good earnings, stock price is going to go up. They're going to get more in form of dividend payments because more profits means more dividends. In either case, it's a win-win for investors. So that's why earnings per share is important, and a lot of investors actually buy stock based on earnings per share because they're looking for their own outlook. If they invest more in that company and the company has good earnings per share growth quarter over quarter and year over year, that's a good stock to be in for as an investor because it's a win-win for them. Okay. Now let's see how to calculate earnings per share. Now let's say a company has a net income of 20 million. Okay, so in a quarter they got 20 million as the net income, and they paid out 2 million in dividends to preferred stock in the last quarter. Okay, assuming the company has 10 million shares outstanding. So a thing about outstanding shares is it doesn't always stay the same. So companies do share buybacks, they do a lot of stuff. And so every quarter, the outstanding shares, that is the total number of shares out there in the market, is going to change. Okay, so this is different from float, which I'll cover later. So the total number of outstanding shares never remains constant. So the company, let's say this company has 10 million shares outstanding for the first half of the quarter and 12 million shares outstanding for the second half of the quarter. So you can to calculate earnings per share, if you don't have an exact number, you can take the average of these two numbers. So take the average of 10 million and 12 million and divide it by 2, you will get 11 million shares as the average. So in this case, here's how we should calculate the earnings per share. So 20 million is the net income. 2 million is the dividends paid. The first part of the formula is to take the difference between net income and dividends paid. So you get a value of 18 million. Then you just have to divide that by the total number of outstanding shares. So 18 million divided by 11 million is $1.63. And you have to consider that in a per share basis. So $1.63 is the earnings per share for company ABC. Okay. So this is how you would calculate the earnings per share. Now, I want to say something about earnings per share. So if a company is not profitable, they're not going to have an earnings per share. Number one point. Number 2 point is you see a lot of analysts out there. They give out projected earnings per share. We think that Tesla is going to make, I don't know, so many so billions of revenue, 10 billion revenue in the next 2 years or something like that, next quarter, whatever it is. They make those projections based on something called as future expectations. So how do you think all these analysts out there in Wall Street, they come up with price targets? So they actually use earnings per share estimates. They key in these numbers manually. So let's say someone is out there, an analyst is out there tasked with to estimate how much Tesla is going to grow in 2 years and come up with a price target for Tesla. So what he or she is going to do is he's going to come and compare what the current earnings per share estimate, earnings per share is, growth is, what the trajectory is, and he's going to look at the company's business model and see, hey, if Tesla actually manages to pull off the solar panels, manage to get the delivery factories in Berlin and China all figured out and actually starting to produce good cars and actually start to sell all these cars and deliver on time, then Tesla is going to make so and so money in the next few years. And I'm going to key in all those expected numbers in this formula, and I'm going to produce a projected earnings per share. So based on that projected earnings per share, he's going to develop a forecast of what the Tesla stock price is going to be at that time. That's how analysts come up with price target updates, and they're going to build. We call that model building. So, and then every analyst is going to build up a model. They're going to build up a theory, say that what needs to happen for Tesla to go from point A to point B. What needs to happen for they're going to have different scenarios. One is a very bull case, one's a happy path, one is a normal path, one is a worst case scenario. So all these different paths are going to have different viewpoints and different numbers keyed into this formula. But that's how you get all these projections. Because half of these companies that are trading at 10 times their earnings rate or 20 times their earnings rate, they're not even profitable yet. But yet the analysts come out and say that they're giving even more and more price target revisions. So the reason that they're able to do that is because they're pricing in all of that expected, they're forecasting all of that future earnings potential into the current earnings, and that's how they're able to project that. Okay, so that's another thing I wanted to tell you guys about earnings per share. So sometimes you may just key in, look at the statement, income statement, balance sheet, and key in the earnings per share and say that, hey, the stock is just producing 1.63 per earnings per share, but the stock is actually trading 10 times or 20 times the earnings, sometimes even 100 times the earnings. How does this even possible? Like, you may just decide to short a stock based on that, but don't do that, because the market is actually pricing in huge expectations for such company, and you don't want to bet against the market like that. So know that it is overvalued, but know that why it is overvalued that way, because stocks can stay overvalued for some time, but eventually if they don't meet that expectation, they cannot deviate from fundamentals and they will pull back and come back to earth eventually. Okay. Now, I just wanted to say that because a lot of people were shorting Tesla from so and so. You know, everyone knows the Tesla short story. Billions of dollars were lost trying to short Tesla. Anyway, so how do you use earnings per share for trading earnings? EPS for trading earnings. So what I do is I note down the estimate and actual EPS of previous quarters and then compare them with the earnings per share expectation for current quarter. So the reason for doing this is because you want to be able to identify a trend or a pattern. So is company ABC has a tendency to beating expectation like all the time, or do they have a tendency to just meeting expectation, or do they always miss expectation? So sometimes a lot of these companies CEOs, they promise the world uh, during all their conferences. So they give all these hyped up earnings estimates and whatnot. Sometimes they will meet, sometimes they won't meet, and companies actually have a very good pattern of doing that, especially if you trade a lot of those mid cap names. They're just trying to make their shareholders happy. Sometimes they end up promising too much, and if that happens, the stock's going to have a big run up leading to earnings. If they meet even a slightly miss their expectation, the stock's going to tank. Okay, you can actually learn a lot by checking out what happened the previous quarters, see how the stock reacted, and see what the guidance was, and then try to form a directional bias. See what happened during the run up, and you'll be able to like increase your probability of success. Companies tend to beat earnings if EPS expectations are conservative. Check previous quarter for earnings ER for guidance, and recent news release for updates to EPS and full year guidance. Checking competitors' earnings releases will also give you a good idea on what to expect. FedEx beat earnings today. UPS also rallied on that news. So on a good earnings week, if a lot of tech companies, cloud stocks are reporting earnings, for example, if one of them did well, chances are the other one's also going to do well. Just do your due diligence and see if the company has enough competitive edge to actually produce similar results. And if they do, you're going to make money. Most of the time, stocks rise when companies beat both top and bottom line expectation and fall when they miss either one. Forward guidance can also influence the stock price movement. So you will hear the terms top and bottom line a lot in Wall Street. So top line is nothing but the revenue, because that is the line that's displayed in the top of the income statement. Bottom line is the net income, which is displayed in the bottom of the income statement. So that's why we call it a top and bottom line. If they beat both of that, chances are the stock's going to rally, but a lot can be depending on guidance as well. If the company issues a very pessimistic guidance, the stock price can react opposite ways. Okay. Now, we've learned a little bit about fundamentals. We've learned about how to read statements, and we know the basics of earnings. Let's talk about a couple of trading strategies. So there are two types of strategies. One is trading the move leading to the earnings. That's what we discussed earlier. And then you can hold options or stocks through earnings releases. Meaning, if you have a position and you want to actually play the report, waiting for the gap up or gap down for that binary event, you can do that as well. So number one, trading the move leading to ER, it's the safest strategy because you're not holding your positions overnight for that binary event. Binary event is earnings here. So the stock can move in either direction based on how the market receives the report. So you don't have to put yourself under that risk. That's why this is the safest strategy. And once your stock direction is confirmed, so based on your analysis and technicals, option flow sentiment, analyst predictions, a history of how the stock used to run up leading earnings, you will be able to capitalize on the IV increase and make good profits leading to earnings. If you make enough profits on the run up, you may actually use part of that profits to trade the earnings result if you really feel like it. Number two is holding the options through earnings results. So holding options, again, is very high risk, but you also have great rewards if you get it right, especially if you're trading directionally. So if you got FedEx calls today, stocks up 9%, so you could make good money tomorrow. If you played Zoom calls, you could have retired literally, because if you really got a good amount on Zoom call holders were making a killing last couple of weeks. And so number one, you can do if you're planning to hold through earnings, check the options flow sentiment, open interest / volume, look at the put call ratio, look at the short interest to get a good sense of the option sentiment. So I will cover what open interest volume is in the next class when I go over Greeks. But open interest is essentially just the total number of contracts that's not yet exercised. So let's say if you have Apple 200 call, okay? If the open interest says 2000 for a certain call option contract, That just says that there are 2,000 people out there holding this option. Okay. Volume just specifies how many of that contract got traded that given day. Okay. Put call ratio is just the ratio between number of puts and calls in general for that stock. And you can get that information on most websites that has an options chain. Short interest. So a lot of these short stocks have a great short interest ratio, and you can get this information I think bi-weekly on most websites. And if you go and check a stock has a very good high short interest, chances are if the company actually does well and beats earnings, they're going to rally like a crazy amount. Zoom, that's what happened for Zoom. So stock actually beat earnings, and there was a lot of short interest in Zoom. So people thought that there's no way that's going to keep going up. So a lot of people were forced to cover because Zoom just rallied like 100 points, more than 100 points, and so people were forced to cover, and that's why we got such a big move on earnings. And eventually it like sold off. But the stock has a great short interest. It's one of the candidates for a big short squeeze after an earnings report. And next thing you can do is read blogs. There are a lot of trading blogs out there, Seeking Alpha and like investing.com. There are a lot of really smart people posting their opinions on stocks. You can read all of that to form your opinion as well. You can read Twitter. A lot of analysts and fitness investors out there posting their opinions on stocks. Read that. You can read Stock Tweets. Again, it's another platform where a lot of people post their opinions and see what all the others are saying. Filter out the noise. Obviously, many of these platforms you see a lot of people who are idiots just posting very bullish opinions or very bearish opinions because they have a position invested in the stock. Filter out the noise. Not everyone's going to produce quality content, but you may able to find someone that's actually producing good content, and that may help you make your create your directional bias for the report. And next, always look at the stock chart. You look at the AD levels. Remember, AD level, we just went over that last class. AD is the accumulation and distribution level. It shows us the strength of buying and selling, buying pressure and selling pressure. Look at this chart on a 1 hour or 4 hour time frame and see what the AD level is showing. Is the stock accumulating? Is the stock distributing? Which phase is it in? And see if people are selling leading to earnings or people are buying leading to earnings. Look at the volume. Do we have a good buy volume? Do we have a weak buy volume? So look at the strength of the trend. Look at key levels. Look at chart patterns. Whatever you can, try to see what you would do if this was a technical setup, because sometimes technicals can foreshadow earnings moves. It may not happen all the time, but it can happen. Okay. And straddle is an effective earnings strategy. So what is a straddle? So sometimes you may have a stock that's implied to make a big move, that's going to make a big move, and you don't know which direction is going to make a move. So in that case, what you can do is you can buy both calls and puts of the same strike price and expiration date, and you're expecting the stock to move significantly in one direction or the other. So let's say you bought FedEx straddle today and the stock moved like calls. So the puts are going to expire worthless, but the calls are going to make money. And if you just do the math, you'll end up making profit if the stock made the implied move. So the drawback of this strategy is that both option contracts can lose value if the stock trades sideways post earnings result. So that's always a drawback. So since you're buying both calls and puts, you're risking twice the amount, and the stock makes a no-show after earnings, then both your contracts are going to lose value, and you're going to lose money like twice as much. So that's a risk of doing straddles, especially in an overpriced market when the implied move is priced in such a way that the stock has to make a huge move to actually make that move. So the implied volatility is so super high on a stock. Your stock has got to make a big move to meet that implied move. And if the stock doesn't make that implied move, then your options are not going to be profitable. Okay. And another strategy is writing covered call out of the money options. And you can just capitalize on the rise in premiums and make money leading to ER. Again, it's a risky strategy, so you stand to get assigned if the stock actually makes the move and goes in the money. But as long as you do covered calls, your risk is minimum. Okay. Trading after the earnings results are announced is another strategy that we use almost every day. So typically after the company reports earnings, the next day you're going to get a lot of analyst opinions, news articles published, a lot of people sounding their thoughts on how great the company or how poorly they reported. That's going to bring in a lot of volume on that given day. And as a trader, what we are looking for is just volume and momentum. On that day, if we get a good trading opportunity, we can just trade that price action and make money after the IV dives down. Okay, so those are the three strategies that we have. Generally, that's what you can do. You can trade the move leading to ER. You can hold options through ER or even equity through ER, and then trading after the earnings results are announced. So some considerations. Implied volatility is the market's forecast of of a likely movement in the security's price. Implied volatility will increase leading to ER. So I will cover this topic in our next lesson because I will be going over Greeks and its IV is closely tied to Greeks. But whenever we trade any kind of option, the market is actually pricing in the options are, we know that options are priced between intrinsic value and time value. So the time value of options has a component called as implied volatility. Okay, that implied volatility is actually pricing in how much the stock is expected to move by within the expiration date. So let's say we got a weekly option contract for Apple, okay, and Apple's option contract is priced $100. All right. So on that given week, the market is expecting Apple to rally $10. So from 100, it's expected to move to 110 or something like that, 110 or 90. So it's expecting a $10 move in either direction. Okay. So for it's the same way during earnings. So the IV is going to increase and the market is pricing in a bigger move. So instead of $10, the market's pricing in a $30 move now within a span of a week. So when IV is so high, the market's pricing a huge price move. With the IV increased, the option contracts are also going to increase in value. So instead of normally if an option contract is priced $200, because of the IV, it may be priced $600 because the market's pricing in 3 times the average move. Okay, so that's what we call as implied volatility. The IV increases because there's a lot of speculation / uncertainty around what might happen to the stock price after earnings announcement. Price can swing in either direction based on the ER outcome. Hence, options premiums will rise before the earnings result and drop right after the earnings release, IV crush. So after the earnings results are announced, the stock price is going to move in either direction. But the market's no longer pricing in a bigger move for the stock. So the IV drops right after the earnings result. So regardless, so whatever move it makes, regardless of the direction of move, IV is going to drop. So the only way for your option to be profitable is if the stock actually goes in the money or makes that implied move. Okay, so that's the only way your option is going to be profitable. And a lot of people may get the direction right, but they may choose a strike price that's way out of the money and they get crushed by IV. So to summarize, all options will lose some premium in time value after the earnings result due to IV crush. Your chance to profit depends on the stock moving in a favorable direction. Ideally, you want your stock option contract to gain intrinsic value, that is, gain in the money. Selecting the right strike price and expiration is important. Now, to select the right option strike price for earnings result, find out what the implied move for the stock is for that earnings result. Implied move is the amount a stock is predicted to rise or fall for a binary event like earnings releases. This information is available in investing websites. The Thinkorswim options chain also has the implied move posted there. I will show that to you in the next class. Or you can also calculate using online calculators. There are a lot of calculators out there. You can use it to calculate the implied move, the exact implied move. Now, if you don't have time to do any of that, a rough estimate of the implied move can be calculated by simply dividing the ATM, that is the at the money straddle price, by the strike price. So let's say FedEx, the stock price is $200. I'm just saying for ball's sake. All right. So take the $200 call option, take the $200 put option, okay, and add those two premiums and divide it by the strike price, that's 200. You will get the implied move percentage by that. just by you doing this. This is not going to be an exact value, but this is how you get a rough estimate of what the market is pricing in as the implied move. Okay. This topic will be discussed in detail in a future lesson, so don't worry about how to select a right strike price. We will discuss that, and I will be going over Greeks in detail in the next class. Okay. Now, last slide, do's and don'ts. Number one, don't be greedy. A company's earnings report is a crucial time of the year for investors. Expectations can change or be confirmed, and the market may react in various ways. So you may do your due diligence, you may spend hours and hours do your due diligence, but there's there are many variables out there. You may not always be right, and there is a chance that your analysis was wrong. As an investor and trader, you should be willing to accept that there is a chance that their prediction may be wrong and be willing to accept the consequences, just like any trade. So when you take a trade, any trade, no matter how great of a setup it is, you're doing whatever you can to predict the right direction, the right move. You're reading price action, looking at volume, looking at the tape, looking at everything that you can, and you're entering the trade. You're doing your best. But there is a chance that your analysis is wrong. And playing an earnings report, trying to predict the direction of a binary event is a hard thing. So there is a chance that you may be wrong. So don't put all your eggs in the same basket. That's what I'm trying to say here. One should never gamble away a large percentage of their account in earnings. Only gamble what you're willing to lose. So if you try to put everything that you have, a large percentage of your account, on an earnings result, just hoping that you hit and you become rich overnight, chances are you may become rich, but most likely you're not going to become rich and you're going to blow your account and you're not going to be trading in the foreseeable future. So if you risk remember, as a trader, capital preservation is everything. If you're risking a large amount of capital on an outcome that you don't have any control over, that's just something that good traders will never do. So don't be greedy, and remember that it's a marathon, it's not a sprint. So never gamble away a large percent of your account on an earnings. The safer strategy would be to play an earnings result with a small percentage of your daily, weekly trading profits. So if you're already up on the week, you hit your goals, and you have, let's say, 500 or $1,000 as excess, like you can use part of that profit and play an earnings report. And if you get a really good return, you can use that profits to play future earnings report. Assuming if you did your analysis and you make money, chances are you can continue to keep winning and make money. You can test your luck like that, but you're not risking your whole portfolio. You're not risking a large percentage of your account. You're just playing with profits, and you're using more profits to play future ERs. Okay, this is a very good strategy. Alternatively, you can trade earnings, the run up, and the report using equity. So unlike options, which has an expiration date and decay, if you actually play using equity, you're not losing until you actually sell. And well, if you're playing good companies, chances are the stock is going to rebound after earnings. After a couple of weeks or maybe after a couple of months, it's going to rebound back. So playing equity is always a good option, especially if you want to trade the earnings report. Okay. So these are some examples of plays that I did earlier in the year. Actually, it was last year. So this is BIBB. They reported Alzheimer's drug, made a 1,200% return. This was Grubhub. I was like, played the downside move, got a 600% return. This was ATV, one of my worst. I hate that stock. I actually lost big. I lost like 4,000. But just like the case is, you don't like to screenshot your losers. This was the screenshot that I found, but I actually lost like 4,000 bucks playing this earnings. I was winning a lot, and I just wanted to use part of the profits and actually go really big on ATV, but they didn't meet expectations. The stock, they reduced their guidance, and the stock actually like dropped. Now the stock's trading above 80, but that time it was a $50 stock. So don't do this. That's why I have the screenshot. Don't be this person. Don't be like me. Don't put a lot of money into an earnings report. Okay, something like this looks nice because you're risking small to make big money, but don't risk big money, because that's if you lose, you're going to take a big loss. Okay. Hope you guys enjoyed this lesson. This was quite a long one, but hope you guys learned a lot about fundamentals and earnings and about companies. Next class, we will be talking about Greeks, but now it's time for questions. Thank you.
All right, guys, let us know if you have any questions regarding today's